For those who are jumping on, we want to first of all say thank you. Thank you for taking time out of your day. It is our goal always here at Blue Heron is to provide relevant education to those who are attending. We will have this recorded and it will be on our website within about a week to 10 days. We will also send you the link. So if you have friends, family that you'd like to share, then you'll have that ability as well. So let's get started. Did you know that March is Women's History Month? So today's presentation is dedicated to women, as you can see in our title, Women, Wealth, and Well-Being. We want to thank Northrop Grumman Federal Credit Union, as we are on April 1st going to be celebrating a 26-year partnership working with Northrop Grumman employees and being the financial advisor arm of the credit union. So we are a Blue Heron Financial Group, and along with myself, I'm Margie Cosmerl, the founder of Blue Heron Financial Group, which will be 29 years this year. I have Joanna St. Clair and Sarah Cosmerl, who will be speaking in just a few minutes and sharing. So if you're in a chair, perhaps sit back, and we just want to provide some inspiration, I guess is the best way to say it, to inspire, but as I always try to do, to also educate along the way. That is a priority for me. It always has been, because the more we can educate ourselves, the more comfortable that we will be in working through financial matters. So to set today's agenda, I'm going to provide some statistics of where we as women are in the world today. And then I'm going to ask you to just do some thinking on what wealth means to you. And then we're going to jump into the behind the headlines. Joanna is going to take us through some slides there, and building your financial foundation. We'll continue on with Sarah in the presentation. So again, thank you. Let's get ready to jump in. So if you would, think about women in your lives who may have planted, whether good or bad, some financial thoughts. I'll share with you, I was very fortunate that my grandmother and my great aunt were women before their time. They were investors. And think about that. This was 2 generations ago. They were investing, and I remember distinctly my grandmother talking about the AT&T stock and her Ford stock. So I think, that certainly planted a seed with me. But I also remember my mom. Now, remember, this is back when credit cards were first coming out. And she said, I'll use a credit card, Margie, but we don't want to have debt on the credit card. We want to make sure we're paying that off. So I remember these things. I also want you to think about young women in your lives. I recently had the pleasure of spending time with my niece and her husband and my great niece. And just as soon as my niece's husband and I started talking finances, my niece got up and left the table. Unfortunately, I think that happens far too often. Now, my daughters have had the benefit of having a mom in the financial planning profession. So they were learning things like Roth IRA and money market at very young ages. And they went on to tell their friends, hey, have you invested in a Roth IRA? So again, we just want you to have some takeaways here. And one of those is to have conversations with our next gen, with your peers, and let's not make finances and talking about money at all taboo. Look what we have been achieving over the course of the last several decades. In today's world, 60% of recent college graduates are out there and earning, 60% women. So again, generations ago, we know that was certainly not the case. We just came off of the Olympics. I thoroughly enjoy the Olympics each and every year. After the winter, I say the winter is my favorite. In the summer, I say the summer is. I love watching everything, and I love the backstories. So in 2024 in Paris, 50% of the women or of those competing were women. And that is a far cry from 100 years ago. And that statistic, if you can believe it, in 1924, there were only 13 women competing, and they were all figure skaters. So we've come a long, long way. As far as starting businesses, I find this encouraging and applaud that women are starting businesses at twice the rate of men. Now, you can be thinking what that and why that is what's happening. I like to think that, perhaps they're younger women and they're thinking of these ideas of oh my goodness, I could start a business in this, and they're actually doing it and making it happen, which is awesome. We also are gaining traction within the government. We've got a ways to go, but close to 30% of Congress. And in leadership, now this is showing us that of the big US companies, a little over 10% of those positions are held by women, but there are 30% women on the board, sitting on the boards of these big Fortune 500 companies. As I mentioned before, not only are women starting businesses, but 14 million businesses are owned by women in the United States. These are very encouraging numbers. But then there's the other side to it. As much as we're progressing, along with that is the responsibility of having more financial wealth. So we are controlling more wealth than ever, and there are reasons for that. There are, in many, many, many households, there are two breadwinners, and in some cases, the woman is the sole breadwinner. We are seeing an intergenerational transferring of wealth, and of that, women are to inherit the majority. That is a huge number that you see there, 47 trillion that will be, and we are seeing it here at Blue Heron. Clients we've worked with for a very long time, as they pass on and assets are transferred to a spouse or to children. Again, women controlling the majority of that. And then in just 4 years, 2030, if you can believe it, it's not that far off, but women are projected to control over half of the global personal investable wealth. These are good moves. The challenges are still in front of us. It has been a grind, or as the picture depicts, a climb to get to these more even playing fields. And we're still not there in terms of, as you can see, this 82 cents earned by women versus $1 for man. There are different reasons, whether it's with women stepping out of the job market for a period of time. Maybe it's the degrees that they are going after. So there are various reasons, but we're making progress. I find this interesting, yes, but also understandable, that 43% of working women are burned out, versus 31% of men. Now, I'll venture a guess, being a working woman and raising kids and a household, there's good reason. There's good reason by the end of the day, we're cooked, as we say. And not that in today's generation, I see men stepping up so much more in helping to juggle all that I just mentioned, but there's still this higher propensity of women to be burned out. 51% of women say that money negatively impacts their mental health. This is something here at Blue Heron we want to try and continue to help eradicate. That would be wonderful to how can we assist in taking the stress that comes from finances, reduce it, at the very least reduce it. So 51% of women saying that money negatively impacts their mental health in comparison to 42% men. We're working on it, ladies. So we have to ask ourselves, what do we want? What do we want as women? What do we want money to represent? What do we want wealth to accomplish? How can we, again, just get that 51% feeling stressed about money and mental health issues? How can we alleviate some of this? How can we be more financially secure? And one of those is to lower or just get rid of debt. Now, I'm not talking about necessarily the useful debt, such as a mortgage, but I'll come back to credit cards. Having high debt leads to stress, and it's very difficult to get out from under that, but it is achievable. And we want to be here to help provide the tools, because that's like step number one. We want to continue to educate, as I mentioned. It's very much a drive for us as financial advisors at Blue Heron, but we want women to feel confident with that continued education. I often get questions, well, how can I learn more? What shall I read? A good book that I recommend is called The Psychology of Money. So I'll just put that out there. Maybe that's your nugget to get that book. And we want to identify goals. We're going to talk a lot about goals in just a bit and what this last bullet is referring to. So if you would just take a minute, and what does the term wealth mean to you? So just think about that for just a second. To some, wealth is providing health, as I mentioned before. With wealth, with financial well-being, it can help with even physical health, mental health. It may mean to some independence. It could mean to have the ability to do things that you desire to do, such as travel. Travel's a big one. I always enjoy talking about travel. So to have a means to the end, maybe that's what wealth means to you. So in our discussion today about wealth, and you may have heard the term before, buckets. It works, so I'm going to go ahead and use it. We want you to think in terms of buckets for your wealth, for your finances. How are you going to save and have that bucket? Many of you who are on the call are still working, and so saving into 401k plan. So that's one of your buckets. Or we are talking in many cases about college planning with our clients. 529 plans aren't just for college. So again, that's a long-term bucket for many, whether it's kids or grandkids. So let's segment that. Let's also talk about the spending, and Joanna's going to take a deeper dive on this a little later in today's presentation. But when we just again segment, okay, these are our long-term goals, and here are our nearer-term spending needs versus discretionary. And then lastly, what can wealth do? And perhaps on your list of priorities is sharing. How can you help the next generation? How can you perhaps share your wealth with even our generation, our parents before, that may not be in the same financial position that you are? So save, spend, share. Those are our buckets. Do you remember seeing this little acronym before, SMART? I think it's relevant to bring it up again. And we talk a lot today about goals and how we're going to achieve those goals. But let's remember what SMART stands for. Specific, as I mentioned in prior slides here. Be specific about what those goals are. Write them down. Make them measurable. What is the timeline? How much is it going to cost to achieve? Make it achievable. If we don't identify it, then with those being specific and measurable, it's going to be difficult to achieve it, and make it relevant to you. If it's something that you believe strongly in your heart and your gut and your head, it's relevant, and so it makes that desire to achieve that much more. And then time bound. Some of your goals may have certain times associated with them. Some, as we just were talking, are shorter term, and some longer term, and being able to discern between those. So I will now turn it over to Joanna. For those of you who have not had the pleasure to meet Joanna, she joined us in October with decades of experience. She feels like she's been part of the Blue Heron team, our family, our work family, for a long time. So over to you, Joanna.
Thank you, Margie. And as we start taking our goals and putting them into an investing framework, we first need to talk about all of the headlines that can be so distracting. They are often drawing on our fears and our uncertainty as investors, because that's what pulls people in to read. But the reality is that we need to work to separate our emotions from our decision making so that we can stay focused and stay on track for these goals that we're identifying. So as we're working through the next half of our presentation today, we're going to look to empower you to keep these noise and chaos and outside events from distracting us from our purpose. So you've talked about what wealth is to you and thought a little bit about your goals. Now we're going to help you get started on creating a financial strategy to get you there that takes this into consideration. So as we start talking about investing, it's important to first talk about risk. So often that just refers to the chance of losing money, but it's important for you to understand that investing to make money also requires a certain degree of risk. So as you are working to develop an investment plan, we recommend that you speak clearly and address this with your advisor so that your advisor can work with you to develop a risk tolerance that is appropriate for you and for your goals. So as we talk about the need to take on some risk in order to invest for the future, we look at setting a risk profile. So your risk profile is often expressed in terms such as conservative or moderate or aggressive, and then that's used to develop an investment plan. Developing this risk profile takes two key items into account. The first is, what is your goal for these investments? Are you investing for the short term? Do you need to make sure these funds are readily available for an emergency situation or for a short-term need? Or are you looking for current income? Are you supplementing your Social Security or pension in retirement and need to make sure that you have additional funds available for expenses? Or perhaps you're looking at a long-term goal and you're willing to take on a little bit more risk because you want your investment to grow substantially over time for the future. So in addition to this time goal, we're looking at how much volatility you're comfortable with. And volatility really just means the degree to which an investment will go up and down, increase and decrease. And so this is often a personal comfort level. What is the maximum amount of volatility that you can experience in your portfolio, these ups and downs of the markets, and still feel comfortable in sleeping at night? So is this a situation where just as little as possible is all you can tolerate, or perhaps a moderate amount or even considerable because you're comfortable knowing that your plan is in place and that you're growing for the future? These are topics to make sure you discuss with your advisor. Here at Blue Heron, we take these into consideration when planning for your appropriate risk profile. And then next, when it comes to investing, is the when portion. When are you going to start investing? Many of us sit on the sidelines thinking, well, now's not the right time. I'm going to wait for this, or I'm going to wait for this thing to take place first. But the reality is, when we're not investing, we're losing because of the costs of inflation. So inflation is the increase in the cost of goods and services over time. So the $100,000 that you may have been spending in 2004 because of inflation will now only purchase you about $60,000 worth of the same goods and services. So by not investing and increasing your investment returns over the cost of inflation, you're actually losing money in a sense. And while waiting for the right time to invest, you're also perchance falling behind because time really is to your benefit when you're investing. The longer your money is invested, the better off you are. So compounding growth and interest really can make an incredible difference in your portfolio. If you were to take $100,000 and invest that with a 10% annual return, that in 10 years would grow to about $260,000. But if you were to hold off and wait and not invest for 5 years, thinking that you'll delay until a future time, that same $100,000 is only going to grow to about 160. That's not 100% change. That's actually a 261% difference, almost 3 times as much your portfolio would grow if you were to keep it invested over that longer time frame. So waiting erodes your purchase power, both from investing and from a loss of time and compounding interest perspective. And then there's also trying to time the market. Sometimes those headline risks can make it seem like it's not necessarily a great time to invest. You might want to hold off because you aren't happy with the way things are going in a particular policy or an economic situation. But the reality is that it is time in the market that earns you the greatest return rather than trying to time the market. So if you were to look at the last 20 years over this time period, the best 24 days in the market are going to occur within the 1 month of the 25 worst days in the market. So if you just missed 5 of those days because you were worried and not investing in the market or had sold out early, you're looking at a difference in portfolio return of about $200,000, about a third of the value. And if you were unfortunate enough to have missed the 25 worst days in the market, well, you've also missed out on those best days as well, and your portfolio would have gained very little from missing out on those enhanced returns. So don't let investment timing drive your returns. Staying invested really is the best strategy. So we know that investing is important and we need to get started. Well, where do we start? Each one of us is coming from a personal start point that's a little bit different, but there are some commonalities just because we are women. We tend to see money as the means to an end. We're looking at using our money to achieve our goals, to fulfill commitments, and to give towards issues that we care about, be that our family or charitable causes. And we face a lot of the same challenges that require choices, sometimes difficult ones. We face career challenges, family issues, caregiving requirements, health and relationship changes. All of these are big personal events that can have an impact on your financial well-being as well. We here at Blue Heron encourage you to bring these to the attention of your advisor when you're looking to make a decision in any of these areas. We can help you determine how that would impact your financial plan for the future and help you make good decisions as you look to these different events in your life. And we know that everyone's path is unique, but there are some fundamental topics that we can consider as we develop this wealth building and investing foundation. We know, first of all, that women who prioritize their financial well-being are better off. They're better situated for meeting their goals in the short and the long term, and they know they can have the confidence that their financial strategy is in place and that they're being set up well for the future. So as we look into our plan for building a foundation, we have developed a 5-step approach to help you get started and build a good, solid plan for moving forward. The first step can be one of the hardest, getting organized, but we want to encourage you to take today's momentum and keep that going and commit to getting organized and staying organized. So here's where you're going to gather all your statements together, your investments, your retirement plans, your insurance statements, your bank accounts, your estate planning documents. Get them all together in one place and begin to try and understand how these are coming together to help you with your financial future. Each household is different in the way they manage their finances. In some houses, there's one person that is responsible for everything. Some have partners and the responsibilities are divided, or maybe it is a partner that handles everything completely and you're not involved. We encourage you to, if you have a partner in your financial life, to become involved and learn about these different accounts and plans that are in place. Or if you're the person who is responsible for putting them in place, educate your partner so that they are also aware and can step in and be part of these decision-making events. We really encourage each member of a couple to be part of meetings when it's time to talk about retirement or planning for the future, rather than just delegating or letting another spouse take that role on. Approach it together. Or if you have living parents, in understanding where your parents are in their financial situation, what their wishes are, knowing where their important documents are, that's important as well. So you can step in and honor their needs if there was an emergency. So as you're understanding and gathering these documents, getting organized, develop a system that works for you, that you can be consistent with and maintain. That can be file folders with tabs labeled. It can be a binder with tabs that outline everything, or perhaps it's digital files that work best for you. Whatever is efficient, that's what you want to stick with, and make sure that your partner or a trusted contact knows where to find this information should there be an emergency and they need to access it. So step two, now that we've got everything together, we're going to look at our goals again. So we talked a little bit about that. Margie talked about the SMART goal system. And now we're going to begin to look at that from an investment framework. So when we're investing for our goals, developing an appropriate investment framework requires us to look at the time frame a little bit more closely. So there are going to be short-term goals. These are things that are going to happen in 3 years or less. Could be paying off credit card debt, could be saving for a vacation or for a house repair. These are things that we're going to want to make sure you have safe short-term money available to achieve. And we have our medium-term goals. These are things like investing for education, making a large charitable donation, paying off your mortgage or refinancing if rates were to go down, or maybe student loans. These are generally in your 3 to 10 year time frame, and they're going to be something that you're going to want to look at separately from long-term goals. We consider long-term goals those that are 10-year plus time horizons. The biggest one, of course, is saving for retirement, something that the longer you have investing, the better off you're going to be. So we want to get that long-term process started. Or perhaps you have a second long-term goal, like buying another home. Maybe that's something that you've always dreamed of with your spouse and is a goal that you identified earlier. As you're putting these goals together and giving them a time frame, we also wanted to explore whether these are needs or wants. Needs are something that's required for your financial success for the future. Wants are something that you have more of a decision and can be flexible on. You can perhaps delay the timing or change the budget for a trip or the amount that you're investing for education or when you buy the home in Cape Cod, but saving for retirement is not flexible. You need to make sure that that is on your priority list for getting your investments in place. So now we're organized, we know our goals, we've given them time frames, and we've talked about risk, but what do we need to do when we're getting ready to meet with our advisor? We need to know our numbers. So not just for companies, financial statements are important for us as women as well. And it's important that you understand where you stand currently financially before you look to plan for the future. So the first thing is taking a snapshot of your net worth. This is really looking at what you own and what you owe. So your assets, what you own, this is the value of your house, your investment plans, your savings accounts, and any other investments that you may have, personal property, as well as your liabilities. What you owe. Do you have a mortgage? Do you still have a student loan balance? Or perhaps you have some credit card debt or an auto loan that you need to account for. The difference between what you own and what you owe is what we refer to as your net worth, and that is a snapshot in time. Your cash flow, on the other hand, is the movement of funds in and out of your household. So what is coming in, your income, your social security, your rental income, whatever those funds are that are coming in to meet your needs versus your expenses, what is coming out of your household each month. And those expenses can be categorized in two ways, just as your goals can be. Those can be needs. This is going to be your mortgage, your utilities, your required savings for the future. Those are needs versus your wants. Your wants are your entertainment. You're saving for more flexible expenses, and perhaps that house that you talked about. Those are going to be wants more than needs. Here at Blue Heron, we actually have a great cash flow worksheet that we will send out for you. What this can help you do is create that dreaded budget. Budgets are not for restricting what you can spend, they're for helping you understand what you are spending. So don't think of it as a something that's going to prevent you from enjoying your financial income. It's to help you better understand where it's going. We recommend that at first you look at it monthly so that you can get a good handle on where your spending is going. But then it's something that you can back off and look at even quarterly or annually as you become more comfortable. So look for that worksheet as a follow-up piece from our call. Also, in addition to our worksheet, there are spending trackers in many banking apps or online apps that can help you as well. So Sarah is actually going to continue here and let us know what the next step is in our financial foundation.
Good. Thank you, Joanna. So step number 4 is get invested in a portfolio. As Margie had mentioned earlier in our discussion, is the goal setting. Know yourself, your goals, and your needs. We are all busy, but taking time to really sit down and think about what those goals are and how am I going to get there. If the how am I going to get there is a bit confusing, that's where asking for help can come in. Maybe it's a trusted friend or family member. And as we talked about in the beginning, that's what we are here for. Talking to a trusted financial professional. We'll have contact information at the end, but sharing those questions, how it pertains to this presentation or maybe something else. As you reach out for help and you get to know your different options, you may be presented with something that you didn't know going in. Maybe there is an option within your 401k plan that you're able to save more than you necessarily thought, and that helps you get to your goals even faster. So reaching out for help to fully understand your options is a great start. Starting now, we talked about different nuggets of information and different action items that you can do, but staying motivated, starting today, and using this as a jumping off point for getting invested. Lastly, staying invested. As Joanna talked about, investing past the headlines, knowing that it's time in the market versus timing the market, being confident in your plan, being confident in your goals and the journey that has been laid out to you, sticking with what you know, being a diligent and patient investor, that is what is going to pay off in the long term. Step number 5, plan your unique path. So we've talked about this. Each one of our journeys to that financial goal is going to be slightly different, but as women, we have a lot of commonalities, a lot of those topics up here on the screen today. And maybe some don't necessarily apply to you, but you don't have to look far for a friend or a family member to know that they are dealing with or going through one of these different situations. So perhaps something you learned today that you're able to share with them. The first we'll start with is parenting and caregiving. For those that are on the call and watching, you might be in the throes of motherhood right now. And on the other side of that, you may be caregiving for a loved one. And as we see on the screen here, the stat, 86% of women have kids. The other stat is 2 out of 3 caregivers for older adults are women. We see this caregiving on either end of the spectrum. It is something that we need to make sure we are taking into consideration as women as we think about our financial plan, whether it's daycare expenses, it's saving for college, perhaps paying out of pocket for caregiving expenses. The average caregiver spends $7,000 a year out of their own funds to help pay for the care of a loved one. We have to make sure that our financial plan to meet our goals accounts for these unique situations for women. On the other end of that, as you think about your own long-term care plans, and we'll talk about healthcare a bit more in a moment, we see these stats up here. These are averages. I'm sure you know friends and family members that perhaps those expenses were much greater. But what can we do today in terms of long-term care planning to offset and protect our loved ones from coming out of their own pocket, or again, spending time out of work, interrupting their goals to help provide for our long-term care? Invest in your health. We want to eat healthy. We want to be active. We want to stay sharp mentally. But it's important that beyond that, we also get down to the dollars and cents of what healthcare is going to cost. We see here that the average healthcare spending is $14,570 per year. If your plan in retirement is not accounting for medical, there would be a large piece missing there. For the average couple, 65 retired, the average amount that they would need to have saved after taxes is $330,000 for healthcare. So again, it is a big expense, and you don't want to be blindsided by not including that. We'll also take a moment to just highlight, if your company offers an HSA health savings account, that can be a wonderful, underutilized, oftentimes place to have triple tax-free saving for healthcare and retirement. Funds go in pre-tax. Yes, you can invest them, especially as you think about this as a long-term care bucket for long-term health needs. And when funds come out for qualified health expenses, tax-free again. So that is our public service announcement to please check into HSA and see and make sure you are utilizing that piece. Social Security. We're going to do very general overviews of Social Security and Medicare, but this again can be very personal and strategies applying to you and your situation. Generally speaking, there are the three types of benefits. The individual, that is your own benefit based on your work history. If it has been a while, or perhaps you have never logged into SSA.gov, we highly encourage you to do so to, I think it was Joanna, know your numbers. We want to make sure we know what that income source is going to be in retirement. Check the work history, make sure everything looks good. If there's a missing year that you know you had income, that's something you want to know ahead of time. The spousal benefit, that is going to be based on your spouse's work history. If 50% of your spouse's full retirement benefit is greater than yours, you are able to take half of their benefit as the spousal. Survivor, this is for our widows. They are able to claim their spouse's benefit, and there are strategies around claiming a spouse's survivor benefit, delaying yours to maximize that. So happy to go into more detail as that may apply to you. Here we have the 3 milestone ages for Social Security. 62 is the earliest one can claim Social Security benefits, but it's going to come at a discount. Each year you wait, depending on your full retirement age, it's either 66 and change in terms of months or 67. By claiming, you are giving up 7 to 7.5% increase on that benefit every year that you wait. An astounding stat that I learned while looking over this presentation is that 70% of those that claim Social Security benefits do so before their full retirement age. So we have to ask ourselves, am I turning this on just because I can turn it on, or am I turning it on because it's part of my plan? There's been strategy and there's been conversation about why this is the right move for me. 70 is the latest you would want to delay Social Security. After that, there is not a benefit to doing so, but between full retirement age and 70, there is an 8% increase. So that adds up, as we know. Social Security benefits for spouses. So these are the requirements in order to take advantage of the benefits. For the spousal benefit, you must have been married for at least 1 year. Your spouse must be collecting the benefit, and your benefit must be less than half of your spouse's benefit at full retirement age. So an example, if your benefit is $15,000, but half of your spouse's is $20,000, you would want to use the $20,000 as your spousal benefit versus taking your own. For survivor benefits, you must have been married for at least 9 months. You can be unmarried or married, and this is the key. If you get remarried, it must be after age 60, or else you're disqualified from your deceased spouse's benefits. The benefit generally equals the amount that the deceased spouse had been collecting. Yes, divorced spouses can also take advantage of these benefits. For the spousal benefit, both must be at least 62. Your ex-spouse does not need to be claiming, but each of you must be 62. You must have been married for at least 10 years prior to your divorce in order to be eligible. And to claim the survivor benefit, you can be unmarried, or if you're married, you must be married again after age 60. Medicare, there over here on the left, we will start. This is our original Medicare. This is made up of your Part A, Part B, D, and then your Medigap or supplemental plan. Over on the right, we have the alternative, which is the Medicare Advantage plan. And just to say, before making a decision about Medicare, especially on the Advantage side, things you want to think about. The premium may be cheaper, but what are the potential out-of-pocket costs you might have later? Does your provider accept Medicare Advantage, whereas original Medicare is widely accepted by doctors and specialists? And lastly, if you go on Medicare Advantage and change your mind later about wanting to re-enroll back into original Medicare, you may be subject to underwriting. Down here at the bottom, we have our enrollment periods for Part B. The initial is the 7 months between ages 64 and 9 months and 65 and 3 months. The general period, if you decide you'd like to make changes, is January 1st through March 31st each year, and surcharges may apply. For those that continue to work past 65 and are on a qualified medical plan, or your spouse continues to work and you are on their qualified medical plan, that's when the special enrollment plan enrollment period comes into play. And that is when you go into retirement and are then enrolling in Medicare. You want to do this within 8 months of your separation. We highly encourage you do so as soon as possible to make sure you are not subject to any penalties. We talked about HSA, and we love HSA. It's wonderful, but something to note, if you are thinking about enrolling in Medicare, you cannot be enrolled in Medicare and contribute to HSA. Medicare is retroactive 6 months. So if you are going to apply for Medicare, make sure contributions to your HSA stop 6 months prior to that enrollment. Divorce and widowhood, two of these life transitions that come with emotion. It comes with grief, perhaps uncertainty, and what feels like a lot of decisions to make. Having a trusted partner walk alongside of you on the side of divorce, making sure that you are thinking about different aspects that perhaps your attorney might not be thinking about when it comes to your long-term financial goals. Maybe that house that you had lived in with your ex-spouse, you want to keep it, but now that you're on single income, having more of your income go towards that mortgage is going to compromise other goals that you have. So making sure you're looking at the full picture and that it is an equitable decision with that divorce and how it pertains to you. For widowhood, again, this is an emotional time that can come with a lot of different decisions. Having someone to walk alongside you and say, yes, this needs your attention right now, but we can wait on these other pieces until you find your footing and you other pieces have started to settle. So having patience and grace for yourself and someone to work alongside you that also extends that same patience is incredibly important. Estate planning. Joanna touched on this earlier. As you pull out the documents, let this be another reminder. This has been a huge push for those that we work with, our clients, in making sure they have their estate planning in order. Maybe you have never done it before, or maybe you did a will years ago, and now it's time to dust it off and make sure it is still applicable. The greatest gift you can give to your loved ones and those helping to settle your estate, again, in the midst of grief, in the midst of a lot of other things going on, one is having your wishes laid out. It's having that power of attorney document, the medical power of attorney document, and your will. The other shocking stat I learned in doing this presentation is that 2/3 of Americans die intestate without a will. So we don't want to be part of that majority, which is just, it's a sad stat. So we are doing our best to encourage those we work with to get this in place. Also, a reminder, check your beneficiaries. Make sure that you have someone listed. Make sure it is still the person you want to have listed. And as we wrap it up here, our next steps, talk to your financial professional. Again, if there are questions that you have, whether it was something in this presentation or something completely different, please know we are here as a resource for you. Assemble your team of experts. Here we are, we're the financial professionals, but we want to have experts on our team in all these different areas that help facilitate our path forward as we move towards our goals for our money and our wealth. Lastly, taking action. We said we will follow up with our cash flow worksheet so you can plot what do these expenses look like. We will also follow up with a worksheet where you can help to identify and set goals and think about what is this path forward that I want to make sure that I am embarking on. Okay, so thank you so much to those that joined us today. We appreciate it and we appreciate your time. We hope that there are takeaways that you are able to use some actionable items as you go throughout your day. We have Jesse's information up here. Please, again, contact us with any questions or comments. And lastly, we want to thank Northrop Grumman Federal Credit Union again for that partnership for coming up on 26 years. And with that, have a wonderful rest of your week, and we look forward to talking with you again soon.